Yo, welcome back, everybody. Okay, so we're going to be taking a look at Target and just reviewing some of the financials on their earnings because they took a crap and are down like over 25% as of right now. So, obviously, not a good earnings for them. People want to say, in short, they had a very big earnings per share miss. That was due to basically inflationary costs. But we'll go ahead and review some of the financials, and at the end of the video, we'll kind of look at another DCF model that I reran to be even a little more aggressive. In terms of the model I ran, there's nothing, in my opinion, wrong with the revenue growth rate we used. It was conservative at 3%. There was nothing wrong with their revenue growth. Like they actually beat the revenue growth expectations by a little bit. It was all about the earnings per share and like margins and everything. So let's go over some of that. So if you take a look here, revenue was 25.2 billion, grew 4% compared with last year. So I mean, yeah, there's it's not the revenue that's the issue here. The issue comes in here starting with operating income. It was 1.3 billion in this first quarter of 2022, which is down 43.3% from 2.4 billion in 2021. This is driven primarily by a decline in the company's gross margin rate. You also have here first quarter operating income margin was 5.3% compared to last year's was 9.8%. First quarter gross margin rate 25.7% compared to 30% last year. So, I mean, what you're looking at here is just a story of inflationary, and they said it, inflationary cost eating away at their profits. So, all these margins you see on the screen, without having to understand the financials deeply, all the margins are going down. There's nothing wrong with the revenue growth. It's in line with expectations. It's fine. We were still more conservative than what that revenue growth rate currently represents on our model. So the issue here entirely is margins being eaten away at due to inflationary costs. Now, this is something I actually didn't see before when I looked at these results earlier, but it says, additionally, the company repurchased $10 million worth of its shares in first quarter 2022. So, I mean, here's the thing with that. I mean, anytime a company repurchases shares, does a share buyback versus diluting shares, this adds buyback of shares adds an immense value to shareholders. But at the same time, this was very, very little shares. I mean, it's a good thing, but it's just such a small amount of shares. It's not really going to help you in the short term here. And clearly the price of the stock reflects it right now that this wasn't really priced in at all because, it's good they bought back shares, but this isn't a large amount of shares by any means. Haha, okay, we've got the financials. So, yeah, you're just looking at some stuff here like actual sales up 4%. Total revenue up 4%. Your cost of sales went up more than the revenue did, which means that your gross margin went down. As we talked about earlier, operating income is down 43.3%. Okay, so your net earnings are down here. And again, it's basically a story of just all the different earnings and margins just being down for the company, including the EPS miss, which is, of course, partially reflected in this. So last year, about 2 billion, and now it's like 1 billion. It was literally chopped a little more than in half. And then here's your earnings per share, as we were just talking about, down almost 50%, 48.2% here, from $4.17 per share to now $2.16 per share. And here we have the little rundown again of the fact that your gross margin rate is down as well as your operating income margin rate is down. And again, all of these, earnings, the EPS, the margin rates down for gross margin and operating income margin, these are all down, again, due to increased cost, overhead cost, inflationary cost. Okay, so I went ahead and scrolled back up to the top because this goes over their actual 2022 guidance. So for the second quarter of 2022, the company expects operating income margin rate will be in a wide range centered around first quarter's operating margin rate of 5.3%, which was down from like the 9 point whatever percent that it was at. So for 2022's second quarter, they're not really expecting it to get much better. When you say a wide range centered around 5.3%, that's pretty ambiguous. That's saying it could be higher than 5.3, but it's saying it could be lower than 5.3. And then it says here for full year 2022, the company continues to expect low to mid-range single-digit revenue growth that we expected and already have built into our DCF model. And then the company now expects a full year operating income margin to be centered around 6%. So, I mean, from the 9+% it was at, they've accepted that, for this full year, they're saying, hey, look, it's going to be dropped down to around 6%, maybe a little under, maybe a little over. Okay, so I think the question that comes to mind is, what does this mean for our model that we previously ran? Because, here we have it, target revenue growth rate of 3% and a free cash flow margin of 4.5%. Now, again, when I run these models, I am running it conservative. So, I do believe that a revenue growth rate of 3% is being a little conservative. And then when we're talking the free cash flow margin, they read as the following: 6%, 3.3%, 5.2%, 8.4%, and 4.8%. For an average of 5.5%, in the model, we stayed a little conservative and dropped it down to 4.5%. With the margins clearly being affected across the board and their earnings, we have to now reevaluate, because we reevaluate companies we invest in based on, every quarter. We have to reevaluate, are we okay with the numbers we plugged into our model here? Now, I am perfectly content with the 3% over the next 5 years. I think that's still remaining conservative on our part. I think that's a great number to stick by, and revenue growth isn't really the concern right now. And revenue growth just really doesn't seem to be the concern right now with them. It seems to be their margins that they have across the board being eaten into by inflationary cost. Now, again, we were already conservative on this model, in my opinion, with the free cash flow margin, but now we have to reevaluate due to the earnings they just had. And it's hard to really say my true thoughts on that, because one quarter doesn't define a company. And even an entire year doesn't define a company. Remember, the inflation's not going to go on forever. We don't know what's going to happen in the future, but inflation's not going to go on forever. And remember, this model's not built off of the here and now based on this quarter or this year. It's based on 5 years out into the future. So you can't look at the model and say, oh, well, it deserves to be an even lower margin, even, 3, 4, 5 years out, because of what's happening right now, because inflation could be well within reason by that point. That, and if you look at the margins over the last 5 years, the lowest it ever dipped was 3.3, but then you have 4 other years representing definitely well above 4 for any of the years. In fact, the majority of them 5 or above. However, I will agree that the inflationary cost eating away at earnings, at EPS, and at the overall margins is concerning. I did go ahead and run another model, which I'll pull up right now. Okay, so here's another model that I ran for Target. We're keeping the same revenue growth rate of 3%, but I dropped that free cash flow margin to 3.5% from the 4.5%. And in my opinion, when we're talking Target, even though they just had a bad quarter due to inflationary cost eating away at profits. In my opinion, this free cash flow margin, like at this point, this model to me is very, very, very conservative. Again, even with the margins being eaten away at due to inflationary cost and the earnings being eaten away at, dropping to 3.5, assuming that this will be the margin for the next 5 years in total, to me, this is a very conservative model. So we run it out as we normally would. We're growing it out 3%, which we did for the last model, applying a 3.5% free cash flow margin rate. We need a terminal value, which we can get by applying a weighted average cost of capital and our perpetual growth rate. Once we have all those values, we need to discount them back, use a rate of return, discounting at 12%, add all the values up, divide by shares outstanding, and you have an intrinsic value of about $151.24. Let's just call it $151 a share. So, that's it, folks. And again, this shows what happens with these models when you change what you expect out of them and how conservative you are. We dropped the free cash flow margin by just, 1%, which I know that they're all small numbers here, but actually dropping it from 4.5% to 3.5% represents dropping our free cash flow margin by over 20%. So that's a big deal, and this is a model that, in my opinion, is extremely conservative. Like, this is about unless things keep getting worse in the future quarters, which we'll pay attention to for Target. This is an extremely conservative model, in my opinion, and according to this model, it's worth about $151 a share fair value right now, which is pretty close to what they are trading at after that big drop. So take that as you will. Again, the last model based on a free cash flow margin for the next 5 years was 4.5%, and the fair value was like 190 something a share. I think it was like 194. But if you drop that free cash flow margin rate, if you're really trying to be very conservative and you don't trust them on the margins for the next 5 years, that puts the fair value at 151 currently. So that's all I've got for y'all, and thanks for watching. Have a good one.